In this week's video, we'll discuss how we tell the difference between a correction and a bear market and how that impacts our risk management strategies. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick off the video with a daily chart of the S&P 500 in 2015, and we will end the video with additional charts from 2015 as of the close on Friday, September 4th. Daily chart, point of the exercise, this is the 50-day moving average in blue. It helps us discern or identify the intermediate term trend. We like to use moving averages because they smooth out some of this volatility for us. The 200-day is a common simple moving average used to understand and discern the longer term trend. When the slopes are up, that tends to be bullish. When they're flat, it tends to be indecisive. And when they roll over, it tends to be bearish from a probabilistic perspective. Everything we're going to talk about today speaks to probabilities based on the knowns of the day. So what can we learn from this chart? We can learn that the longer term trend now is rolling over. This is concerning. This is a long rollover here. Notice how long the slope of the 50's been down. It looks different than most of this over here. And we have what's known as a death cross. The death cross doesn't mean a whole lot in the short run. It's absolutely relevant. I wouldn't read too much into it in the short run. It's like any other thing that we can see on a chart. The longer it remains in place, the more valid it becomes. And some of the examples that we go through will help make that point. We've got the death cross and we have the rollovers. This is a full bore bearish look. Blue below red, price below both, and the slopes of both are down. We get to this point, can we declare that we're in a bear market? Before we examine this 2000 to 2003 chart of the S&P 500 daily with the same moving averages, I can't emphasize enough, we are not advocating building a system based on the 50-day and the 200-day in isolation, and we'll cover that in a little bit more detail later with some stats. These are common moving averages. They are used by the market model. They don't particularly have a heavy weight. These are common moving averages that we can all understand, and they can help us illustrate basic concepts about trends and counter-trend rallies. So our look here in late 2000 is similar to the look that we have today. Notice here's a sharp counter-trend rally. Why do we have such strict rules in place and restrictions relative to when we can use inverse ETFs? Here's your answer. This is a bear market. You would think that if you were using inverse ETFs, it would be a cakewalk, right? This looks like a bear market. These are counter-trend rallies. They're normal. This is a 4% counter-trend rally. Keep in mind, if I'm using an extreme example, and let's go to this 20% counter-trend rally. If I was invested 100% in an inverse S&P 500 ETF, and we would never be able to do that within the context of the rules. I'm using an extreme example for illustrative purposes. If I short with SH here, and I hold it through this counter-trend rally here, I not only miss a 20% rally, but I lose 20%. So during this period here, every day the market goes up, I lose money, and I'll be lagging the market by 40%. So the moral of the story is not to say that SH or inverse ETFs don't have a place. We can use them in the market model, but this gives you an idea of why we have very, very strict criteria and rules. So this is basically what a bear market looks like. Full bore, bearish look that we just saw on the present day chart, and we have the sharp counter trend rallies. Notice the trend. A lot of volatility in here, but look how easy it appears to follow this trend. The 50 helps us identify higher probability periods of counter-trend rallies. Again, we're not advocating using these two moving averages for a system. We can use faster or slower moving averages, and the market model is diversified. Same exact concepts apply to the financial crisis bear market. We get the death cross here and a full bore bearish look that starts somewhere in here. Notice the sharp counter trend rallies that occur, but the primary trend is clearly down. Now let's take another snapshot from history. We're looking at a daily S&P 500 with the same two moving averages. S&P here, 50-day in blue, the 200-day in red. The topic of this video: how do we tell the difference between a correction and a bear market? The other thing that we can learn, this looks incredibly bearish. This is very, very similar to the look today. We have a little bit of white space in here, and we have a sharp plunge. We have a little bit of white space in here in 2015 and a sharp plunge. This means a new bear market has started. That's not really fair to say. So let's take this historical setup here that we just noted is similar to the present day as of the close on Friday, September 4th, 2015, and ask the question, what happened next? If you really have studied charts, you may have already figured out that what we were looking at was 2011. What lessons can we take away from this chart? First, one of the biggest mistakes that we can make using a system like this, and I want to emphasize, any comment that I make in these videos or on Twitter relates to our system, and by no means, by any stretch of the imagination, are they meant to be critical of other methods. There are a million different ways to approach the markets and skin the risk management cat. Ours is one way. It is not the only way, and we respect that there are numerous alternative methods. Our comments relate to our method. Under our method, one of the biggest mistakes that we can make is to decide in here that a new bear market has started, or to make a forecast or to write an article that states a new bear market has started. I say that after going through the school of hard knocks. Experience says, keep an open mind. If I tell you in here that a new bear market is kicked off, I'm a human being and my ego is going to come into play. When this starts to go in this direction, I'm going to rationalize away what I'm seeing, and I'm going to lose the required flexibility that I need to adjust to changing information. Under our system, the way that we look at things is, this chart at this point is taking all of the knowns today, and this chart at this point is forecasting a bear market. If you really followed the markets closely in 2011, it was Europe that was the big problem. There was no solution for Europe or no Band-Aid for Europe. They came up with a Band-Aid here. Therefore, new information came to light, and the market's probabilistic forecast adjusted to the new information, which speaks to flexibility. In 2015, are we in a bear market or a correction? The answer is we don't need to know that. The math looks very, very similar during the early stages of a bear market to what we would see in a correction. It's very, very difficult mathematically to discern between the two. Why? Because right here, the market actually does think we're going into a bear market. Something changes here with intervention, and we always have to be open to that. So to answer the question, how do we differentiate between the two? The answer is we don't, and we purposely try not to. We can only do it with the benefit of hindsight. We're better off just taking it day by day. If this chart morphed into a 5-year bear market, the data won't miss that, just as the data doesn't miss this. Here's an example. We always say the hard data won't miss a turn. If I was just using the 50-day moving average, notice the slope of it turns up here. If you invested here, you really didn't miss a whole lot. We went down, we went up, and you still were able to capture all of these gains here. So we don't need to anticipate or forecast. In fact, under our system, we're better off not doing that. We need to do what we do every single day. We need to look at the hard evidence. We need to look at the readings of the model and ask the question, are we allocated properly based on the evidence in hand? If the answer is yes, leave it alone. If the answer is no, the evidence is changing and the math is improving, then we make incremental adjustments as needed. So going back to 2015, in terms of how it impacts our risk management strategy, it doesn't. We just continue to do what we always do. We acknowledge that this is a risky look, and that is reflected already in our allocations. We have a ton of cash. We have a good position in bonds. We have cash and we have bonds. Why? And why is the cash position so large? With the Fed potentially tinkering with interest rates, we are acknowledging there is risk in the bond market. The cash is acknowledging that risk. We're also acknowledging risk in the bond market by diversifying away from just TLT. Clients know that we have multiple bond positions, and I might add all 4 of them, fortunately, were up on Friday, September 4th, when the S&P 500 was down 1.5%. Monty Hall can help us quickly summarize the weight of the evidence. These are the charts that we looked at last week. It's a holiday weekend and everybody wants to be doing other things. Therefore, if you want to gain a full understanding of what these numbers mean, you can Google this title here. You can pause your video player down here. Once you Google it, click on this link. You'll go to last week's video, and then fast forward to the 2-minute and 14-second mark. If you watched last week's video or you watched that clip, you know these are summary scores. This is telling us that the trend is strong here. It's a little bit undecided here. How does the same chart look today? The answer is much worse relative to the day of the bottom. These are V bottoms. This is what the same chart looked like on the day that the market bottomed. This is a full-bore bearish look with price below all the moving averages, blue, the fastest moving averages on the bottom, and the slopes of all of them are down. What does this number look like today? Therefore, can you please show us what's behind door number 2? A 6. Last week it was a 4. A 6 is also telling us to be patient. The 4 and the 6 did not allow us to buy this week during those counter trend rallies. Why? The evidence had not improved yet, and it helped us avoid a very, very difficult week. This number 6, like 2011 at the bottom in October, is the probabilistic forecast based on the knowns as of Friday, September 4th. Just like in 2011, the knowns can change next week, and the chart can change. Therefore, maximum flexibility. When the chart begins to change, the score will change, and we will make adjustments as necessary based upon hard data, the model, and the rules. The changes that we make will be in line with the magnitude of the changes in the evidence. If the evidence improves quickly, we scale in quickly. If it's kind of a slow situation, we would move more slowly. As clients know, we have taken the principles of trading and we have moved them to an investor's time frame using an investor's risk tolerance, meaning all things being equal, we would prefer not to go from fully invested to 100% cash in a day, which is very, very easy to do if you're trading your own account. We're not doing that. Therefore, our system has been adjusted to meet the needs of investors. Question: am I better off building a system for investors that's based on 2 moving averages, or am I better off doing what the market model does and diversifying? We use the market model to invest our own money and to invest the hard-earned money of our clients. This is serious business. Therefore, we are not going to hitch our wagon to a single moving average pair system. We're not saying there's anything wrong with that. Under our system and for our needs and for our audience, we're not comfortable with it. Why? We've done rigorous back testing. This is a quote from MarketWatch, and what it basically says is, going back to 1896, a simple moving average crossover system using the 50 and the 200 did a respectable job. However, its performance varies significantly over time. It worked better from 1896 than it did from 1970 forward. It worked well in both periods, but the variances were significant. What does that mean? Does that mean that trend following worked well from this point to this point and didn't work so well here? Doesn't mean that at all. How do I know that? I've done rigorous back testing. Trend following always works. If there are trends, the math will not miss it. The only question is, what pairs will necessarily work better than others in different instances? And that does vary. Therefore, rather than hitching our wagon to one star with one set of moving average crossovers, we acknowledge that any backtesting is a form of curve fitting. Example, let's assume I were going to build a day trading system, and I looked at the 2-day moving average all the way up to the 100-day moving average, and I backtested them. One of those moving averages would produce the best returns. If I picked that moving average, let's say it was the 12-day moving average, and threw the rest of them out, that's curve fitting. That's taking the best option based upon the data I studied. If the 12 worked pretty well in the past, it's probably fair to say that the 8, the 9, the 10, the 11, the 12, the 13, the 14, and the 15 will probably end up being the best going forward. We don't know which one it is. They'll probably all add some value. So this quote and this fact here, that little nuances can give you different returns over time, is why the market model is so highly diversified. MarketWatch said the search continues for the optimal market timing indicator or indicators. The search would go on forever. There is no optimal market timing indicator or indicators. There is no optimal moving average pair for any time frame. It varies over time. If you build a system that acknowledges curve fitting, you can acknowledge that in advance and account for it. Just want to emphasize one more time, comments here relate to our approach to the markets. They do not relate to other systems, especially shorter-term trading systems. We're a little bit of a different animal. We respect all systems and all approaches. My comments here are not meant to be critical of any system. Back to the present day, S&P 500 daily. As of the close on Friday, September 4th, want to make 1 point and 1 point only here. Fibonacci retracements, as we know, what do they help us with? They help us with trends and counter trends. Point A here, 2134, we had a move from point A to point B. We can use fibs in this direction as well. These are the fibs from high to low. If the trend is down, a normal counter-trend rally could go to 1969, 2001, or 2032. If we go to one of these levels, that doesn't tell us that the downtrend is over. If anything, if we go to these levels and bounce in the other direction, it somewhat confirms the downtrend and says that was a normal counter-trend rally. If we blow through these, then it does put the downtrend in doubt. You will see, we've been looking at these fibs now for some time. We knew about them before this rally here. You can see we rallied back into a normal retracement zone, telling us as long as we respect these fibs, the probability of this being a normal counter-trend rally within the context of a downtrend is still good. Doesn't tell us anything about what's going to happen next week. It just speaks to what we've seen already. This is a weekly chart of the S&P 500 as of the close on Friday, September 4th. Remember we said the fibs work in both directions? This saying works in both directions as well. What once was resistance may now act as support. What once was support may now act as resistance. We broke support here on the weekly chart. We went back up, stopped at a relatively logical place. This is an angle here. The market made this angle before we stopped here. Markets love angles. This week, we made a lower low, telling us that the probability of going into a weekly downtrend is just a little bit higher today than it was a week ago. This is one of the charts that was very, very helpful, helping us be patient during this week's sharp counter-trend rally. The S&P ended up down 1.5% on Friday after that counter-trend rally. What once was support may now act as resistance. The only thing new here that we need to point out, this line here was relevant here. It was relevant here. It may be relevant again. Not a prediction. Just want to be aware of it. Remember in last Friday's video, we showed an example of a hanging man, which was a potentially bearish reversal pattern in the S&P 500. And indeed, we did reverse on Monday morning. Here's another example from this website here, world.nsfx.com, right here. This example here. How do these charts compare to the close on Friday, September 4th, 2015? Here's last week's look, and we did go down. Here's this week's look. Let's walk through the psychology of it. Patterns aren't patterns. They're people behind these charts with emotions. Here's one interpretation of this week's action. This doesn't feel very good. It's very difficult to buy here. Traders stepped in here and made a good decision. A lot of them probably made money. So this is a bullish look here. Remember on Thursday, you can remember what it felt like. It felt very, very bullish in the morning, and then by the end of the day, if you were a bull, it felt very, very disappointing and bearish. And that's exactly what this candlestick is telling us. It's telling us that price was driven way up here, and then the close brought it down to the lower end of the range with a very indecisive look, a relatively even battle between the bulls and the bears here, similar situation here. Now what we have, we get the sell-off. What does this tell us here? This tells us here potentially that the people that missed this and were in cash at the end of the day said, hey, I didn't buy last time. I think I'm going to buy this time. See, it's reflected right here. This is what's known as a long tail. A long tail. Look how similar the general setups look. Bullish, bullish here, indecisive here, and then we get a hard sell-off with the regretters, I regret not buying this, pushing us back up into the close. I regret not buying this, pushing us back up into the close. As I said last week, this is a setup. It really tells us absolutely nothing about what's going to happen on Monday. It just tells us that the probabilities lean bearish. This chart here knows nothing about the news that will take place on Sunday and Monday when the stock market's closed. If the knowns change, then this setup may fail and we need confirmation. As I said last week, this is an implementation thing for us. It really has very little to do with the model. And if this isn't a hanging man this week, it's really not going to change anything that we do. As always, as we head into next week, if we have a flexible, unbiased, and open mind, the charts, the hard data, the models, and the rules will guide us. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.